You know, a quarter is weird when a massive paper swap for Visa shares makes America's largest traditional bank look like a hypergrowth tech stock. Welcome to Earnings Unscripted. It's July 14th, 2026, and today we're breaking down the second quarter for JPMorgan Chase, ticker JPM. And Miro, those headline numbers look almost absurdly good.
They really do. At first glance, they posted earnings of $7.70 a share, which looks like a massive beat. But if you actually dig into the filings, they booked a $4.6 billion net gain just from exchanging restricted Visa stock into liquid shares.
Wait, so they essentially just traded paper they already held for different paper, and that flowed straight through to inflate the net income.
Exactly. It completely distorts the reality of the quarter. Once you strip out those special items, their core net income was practically flat from last quarter.
Got it. And real quick, just a reminder that this is two friends talking, not financial advice, so please don't rewrite your portfolio based on our banter. But investors clearly figured out that accounting quirk pretty fast. The stock gapped down hard pre-market, then caught a massive bid right before the call and just kept climbing to close green.
Yeah, the street looked past the headline trick because the underlying business is moving so fast. Total managed revenue hit about $58 billion. The investment bank and equities trading desks are basically running at redline right now to handle client volume.
And the everyday commercial lending side is busy too, but in a really unexpected way. Jamie Dimon was talking about the artificial intelligence boom and how it's not just tech companies buying chips.
Right, because those chips need a physical home, so the bank is suddenly seeing huge loan demand from everyday contractors, plumbers, and electricians who are physically building out these massive data centers.
It just proves how AI trickles down into the regular brick-and-mortar economy. But obviously, all that trading volume and new construction lending requires a lot of manpower and compensation. And didn't the CFO just heavily raise their expense guidance for the year?
He did. And Jamie Dimon went out of his way to crush the whole Wall Street fantasy that a bank can just infinitely scale revenue without paying up for talent and overhead.
I absolutely need to hear how Dimon delivered that reality check, because nobody punctures a Wall Street narrative quite like him.
Oh, he didn't hold back. He literally said on the call, "The notion that somehow you can forever increase your operating leverage is a crazy notion. We don't have that. I think it's part of the reason why banks failed 20 years ago."
Wow. Okay, you don't usually hear a CEO invoke historical bank failures to justify spending more money.
Right, but he has the capital to be blunt. They bumped their adjusted expense outlook up by $2.5 billion. So they're expecting to spend around $107.5 billion for the year. And the analysts were getting angsty because traditionally, if revenues pop, you want costs to stay flat so margins expand.
Sure, that's the whole tech model, right? You build the software once, and the next million users are basically pure profit. So I guess analysts are asking why JPMorgan can't just do that.
Exactly. But banking, especially on the institutional side, isn't software. It's highly bespoke. When equity markets revenue spikes, I think it was up 86% from last year, you aren't just flipping a server switch. You're paying huge performance bonuses to the actual traders who executed those complex trades.
Okay, wait, let me make sure I'm processing this. So because they had this massive surge in the investment bank, they physically have to pay out more in compensation, meaning their expenses have to rise mechanically alongside the revenue. It's a structural cap on their operating margin.
Mostly, yeah. The CFO laid it out pretty clearly. The higher costs are overwhelmingly tied to that revenue outperformance. You can't have record-setting desks without paying the people manning the desks, which actually ties into something else they did recently with their leadership that really fascinated me.
Oh, the management shuffle? Because Marion Lake retired, right?
Right. So they elevated Troy Rohrbaugh to co-president. What's wild is that he's taking over the consumer bank, but his entire background is on trading desks. He's a former options trader.
Okay, hold on. A derivatives guy running retail checking accounts and auto loans? That feels, completely mismatched. Why wouldn't you put a retail veteran in that seat?
Because Dimon hates silos. He thinks the main problem with rival banks is they let executives grow up entirely inside one bubble. If you only know investment banking, you starve the retail side, or vice versa. He wants flexible minds who can look at the whole balance sheet.
Oh, that makes total sense. You're building a CEO successor, not a branch manager.
Precisely, and an options trader thinks in terms of risk pricing and system feedback, which is exactly what the consumer side is dealing with right now because retail banking isn't just about handing out mortgages anymore.
Right, it's about deposits, which actually, were deposits mostly stable this time because everyone's been slightly paranoid about deposit flight ever since the regional banking stress?
They grew a tiny bit sequentially, but management flagged a very specific risk. They're seeing what they called yield-seeking flows, meaning regular people are finally waking up, looking at their checking accounts earning near $0 and moving that cash into higher-yielding products.
It's amazing it took consumers this long to realize they're getting squeezed on interest. So wait, if everyday retail cash starts demanding a real yield, wouldn't that eventually force JPMorgan to pay up just to keep that money in the building?
Yeah, that's exactly the risk. If rates stay higher for longer, the bank eventually hits a wall where they can't just offer practically zero on checking accounts without bleeding deposits to competitors. They call it convexity on the call, but it really just means eventually having to bribe your own customers to stay.
Bribe your own customers. I mean, it's honest. But right now, management doesn't seem like they're sweating too much over it, right? Because the forward guidance still looks incredibly strong.
True. They actually bumped up their full-year target for net interest income, if you exclude the markets division, to roughly $96.5 billion, and the American consumer is holding up just fine. They lowered their forecast for card charge-offs to approximately 3.2%.
Okay, so the consumer's resilient, the investment bank's on a record sprint, and they've got enough scale to basically shrug off those massive compensation bumps. It feels like they're firing on every single cylinder, which naturally makes me nervous. What happens when you run out of gears?
It makes Dimon nervous, too. He gave a really stark quote. He said, "It's getting close to as good as it gets. We just don't know how long it's going to last." Plus, the CFO openly wondered if all those high-profile IPOs they closed this quarter actually cannibalized the deal pipeline for the fall.
Right. A classic pull forward. You drag tomorrow's revenue into today, and then suddenly the back half of the year looks awfully quiet. So the big question now is whether this was a spectacular anomaly or the new baseline.
Exactly, and we'll see if they start deploying capital into actual acquisitions instead of just share buybacks at these prices.
Well, if things do slow down, at least they've got that massive Visa paper fortune to keep them warm at night. Thanks for digging through the mats with me, Miro.
Always a pleasure. See you next time.
If you like getting the story behind the numbers while you're on the go, tapping follow on your podcast app is an easy way to stay updated. And full transparency here, we're both synthetic voices reading an AI-written script, which is exactly how we turned JPMorgan's massive second quarter data dump into a listenable episode today. Tell us what you think or throw a ticker request our way at earningsunscripted@datamadness.ca or catch the X link in the show notes.
Thanks for listening. We'll catch you next time.